Good afternoon. This is our Saturday 3 p.m. webinar. And as usual, we always give you the topic that is really hot on the market. So a lot of times you see our topic because someone had asked us that question and we felt that's important to you. That's why we bring that out here. Um, you can tell from our website, and we do have these buttons on the top that service you. And if you're such a busy entrepreneur, just doesn't even have time to call us, but you are on our YouTube channel all the time, you're so familiar with us already, and you can onboard with us immediately without waiting. You can just click the onboard with us and then design your own username password. Then you can start loading your questions and your paperwork. Then we will come back to you and get you onboarded. Of course, the appointment button is for you to meet us on video conference, and some of the partners on the appointment list has the 30 minutes free appointment offering, so you can actually ask questions via that channel, and then you know that whether we are the best firm to service you. All of our webinar content is coming to YouTube channel. This is the place all of our past knowledge, current question, answers, and what's in the trend is all here. So we answer questions and we resolve issues. And our goal here is just to share our knowledge with you without costing you a penny. And subscribe to our channel. And you notice that we're over 6,000 followers, and we have more than 1,500 videos in the queue. So it's really quite an interesting collection, and we hope that you enjoy that. Let's get going with our webinar today. And today's topic is a question we got from our client, and the question is about keeping business separated from the real estate. So what is the thinking behind that? So why it is so critical, or why it is doesn't matter to have the property be accounted with your business. For example, if you own a restaurant and you also own the building of the restaurant, is that okay to just put the building in the restaurant, file one tax return, one thing, or it is probably better to separate them? We're going to tackle that issue. Of course, it is not a yes or no simple answer, right? Depends. That magic answer is always depends. But this webinar will give you a taste of depends on what, right? Obviously, we cannot go through all the scenarios, but it gives you a taste of varieties. Then you can go from there. If you really need to dive deep in terms of your estate planning, in terms of your asset protection, you have Community CPA, with you, and you can always contract us to service you with your need. All right. Just in case you don't know our firm, we have more than 27 years practice history. Well, yeah, 27 years. That's someone's, big part of the life is in there. Imagine it is not one person, 27 years. We're talking about 40 professionals. So that's a lot of years if you calculate it that way. And we speak collectively more than 10 different languages. That also give you a view of our professional staff. We're from all walks of life, and we speak your language, and we understand you. And we have collectively more than 12,000 clients worldwide. We have 5 branches. The Houston, Texas one is our newest. We started in June of this year. And I myself served on the national committee, which is to provide advices to Internal Revenue Service, IRS, from 2019 to 2021. So that's a 3-year volunteer work I have done. Of course, I will never stop bragging about the book that I wrote. I have an 8 a.m. book which talks about how to start up a business. I have a 10 a.m. book which talks about how to grow your business. I am writing, drafting, figuring out how to write 2 p.m., which is expanding your business beyond yourself, right? I could never say that I am not ready for that book because community CPA are still in the phrase of expanding. Where we did Houston expansion, which is our number 5 expansion, but I wouldn't call it done. So the 2 p.m. book still need a little bit of time, but you understand what I'm doing now, right? So I'm writing this book for you, our client, and myself. So when I go through beginning, when I go through growing, when I go through expansion, I talk about my own journey and along with the client that follows me and coming to this stage of the business. So the 6 p.m. is the last book in the 4 book series. That one will talk about retiring from your business, or maybe we call it repurpose your life. However, we do right now, that book just have 1 page says no retirement. So I'm not ready to really do much about that one yet. And this webinar, we always tell folks that no responsibility disclaimer because we don't want a free knowledge to become a liability for us. We want you to engage us for a fee service. Then what we have provided you would be covered by our professional liability insurance. And for a webinar like this is a free knowledge. We hope you collect them a lot from everywhere, then make a sound decision for yourself at that moment. If you still feel uncertain and you want professional input, come to us. We would love that. We would love to help you. Now, we got these questions coming our way. Does your business require real estate for its operation? And do you hold property title under your business name? You know, with long-term tax liability, estate planning advantage, separating real estate ownership from business is a overall wise choice. But of course, if I just say, okay, I'm done, and you need to separating it, and did you hear that? That wouldn't be useful webinar. So I want to go in to come back to what I concluded here. You generally speaking, and you should have your real estate and your business separated. Okay, let's take a look at what we prepared for you. The treatment of business expenses. Businesses that are formed as a C corporation treats real estate asset as their equipment, inventory, and other business assets. They listed on their balance sheet to be one of the item on there because they are corporation. Corporation owns the title. Any expenses related to owning that asset appears as ordinary business expense on the income statement. So generally is the tax deductible in the year that they incurred. For example, if you have a utility cost for the building that you have, you would deduct utility, right? If you happen to fix the paveway for your customer walking on it, and that fixing is actually your expense, just depends. We book them under asset, but just depends on the depreciation set of incentives that IRS give us, then we treat it differently. So, nowadays you have what we call the Section 179, you have bonus depreciation, all of that can come into play for you. So, how taxes affect a sale? When C corporation sells the real estate, the profit are taxed per se twice. So hear me. This is not what we are talking about double taxation. We're talking about the profit of selling this real estate because you own the real estate under your C corporation, right? So let's say the building was $100 and you when you sell it it's $200. Simplified example. So you got $100 profit. And at a corporation level, you always gonna have that. You're always gonna have that corporation tax that coming in, right? So you will pay corporation tax, and it was 15%, now 21%. Then it may still change. 21% is actually set in the law, so right now it's 21%. So once it's got taxed, it's become your retained earning inside of your C corporation. If you want to distribute, or if you want to pay yourself dividend over the money that you made out of the building, and you distributed out the dividend. That's why this is where they say that, oh, I already paid corporation tax, I'm paying dividend tax again on my 1040, which is so true. However, not every twice taxation giving you absolute disadvantage. You want to calculate that because dividend tax is a lower tax rate, and your 21% corporation rate could be so much lower than what you got on your 1040. You may be paying 37% of income tax, then your dividend tax will be 20%, then you add together is 57%. And it's still better than paying 21% in the corporation, and you don't have to be in a hurry to pay yourself a dividend. You can pay that later, right? Double taxation is avoidable. So that's why I say that double taxation is a planning technique, and you can avoid that. If the ownership of the real estate is transferred to a pass-through entity instead, or transferred to, I wouldn't say transferred, sold to the individual, then the profit will be taxed on the individual level. So how did that come around? So give you an example. If you have this building under the restaurant, and so a tax strategist come around, goes too much risk. Let's just separating your restaurant from your business. So you would actually the restaurant would sell this building to the owner. So one owner has the building, so it's either under a pass-through entity, maybe a LLC, a title holding company, or maybe just under its personal name. Then when you sell the property, it is a capital gain, maybe with recapture gains, but basically you just get taxed once under personal. But personal tax rate has the highest rate, right? Of course, you could have capital gain that is up to 20%. So with that said, it is a tax puzzle. It is something that you don't want to be so fixated on a thinking. In fact, it's nothing about just thinking. In tax is a lot of mathematicals. That's why we always say that, if someone really understands taxes, and what's going to happen to them is that there's a lot of mathematical calculations in their mind. And I felt like a lot of times, and the folks are losing the focus of what the strategy is, but only look at the one of the rate they were focusing on. So they will draw conclusion goes, oh yeah, I paid 2 times taxes, I'm paying too much. No, you're paying 2 times could be 2 times low rate, add together still lower than what you're going to do in one shot under your 1040. All right, then safeguarding asset, right? Separating your business ownership from its real estate also provides an effective way to protect your real estate from creditors, from other claims, right? For example, if your business is sued and found liable, a plaintiff, the person who sued you, may go after all your assets, your inventory, your building, anything on your balance sheet, right? But if the plaintiff cannot touch the property, and because it belongs to you personally or belongs to a LLC holding company, then your business, even though at fault, it can come out of the business structure, come out of the business legal structure to penetrate into your personal side. This strategy, can actually protect you from losing all of your assets in one basket. That's why sometimes you wonder, right? Some big business people, why do they set up so many companies? Wouldn't that be easier if we just combine all the company under 1040 under Schedule C? So we file one tax return, save a lot of money from the taxpayers. Why are people doing that? Because every business endeavors carries different tax risk level. I always say that if you have properties, individual family property, and apartment building complex, then commercial plaza, all three, you should have separate LLCs because their risk level is just not the same. They have a different risk level. Of course, there's also estate planning implication related to the building, the business. Separating real estate from a business may give you some estate planning options too. For example, if the business is a family business, but all members of the next generation don't care about your restaurant, right? Just don't care. And separating the property will give you an extra asset to distribute and to give to the future generation. You could sell your business, right? Or you could just get rid of your business, but your property will still be there generating revenues or be sold and give that to your next generation kids who just don't like your business, right? Isn't that true with a lot of business owners? And you raise your kids, they grow up in the kitchen, and really would be nice if they like what you do, but no, they don't. So you ended up with this end of the business kind of future. You know that business will go somewhere, will be sold, but you don't want to sell your business and the building together. Maybe you like to keep the building for your children so they can get passive income even after you're gone, but you can sell the business for other people to run. So this is also our question. Our client come around and goes, who should own the real estate? Can I just give that to my children? Can I just own it myself? So one option, the business owner can purchase real estate from the business, right? I mentioned that. And hold the title under his or her name. So it becomes your personal property. And the one concern that would create is that not only the property that will transfer to the owner, but also any liability related to it. Of course, if you have a loan with the property, that company is the one, is the mortgager. So when you sell, and you got to figure out how to clean up your loan so you can sell it clean to the business owner, right? Any liability related to the property, it will go to the owner if owner take it, right? So for in addition, any liability related to the property itself may inadvertently put the business at risk. So basically, we want to make sure that you want to have this separate liability insurance always for the building and for your operation. So in those cases where the building and the businesses are in one legal entity, so what we always advise our client is the insurance need to be very separated. So you want to insure the building inside out, up and down, left and right with one commercial building liability insurance. Then you want to insure the general business with another insurance. So with that, then you can carve it out even though you didn't sell that to the owner. But if you are going to sell that to the owner and have owner owns the commercial property, you know it is important to make sure that that liability is still in place, right? You can make the business pay for everything. Building owners, I like to tell you, you know triple net, but you can also make sure that everything is paid by the renter. You decide. Otherwise, you don't rent to the renter. So that means as a business, as a building owner, you don't have any expense. You only have rent income. Okay. So if you really put that under your name, I would highly encourage you to have yourself be as simple as possible. The rent income, expenses, maybe only the mortgage expense that you take on, and the property tax, insurance, maybe not. So you can really decide on that. The key is, yes, you can own it, but you want all the liability being taken care of. Okay, so what about the business owns the real estate, right? So this is where you can set up. There's two ways we're talking about business owning. One is earlier we said you have a corporation. The building is already in there, so it is already owning that property. Then we want to make sure that your insurance agent is going to work really hard for you, and the insurance agent is going to provide different insurance for different assets you have in the business. You may even want to buy insurance for your walk-in cooler. Of course, it is possible. So making sure your cars that you use in the business, right? So no different from your property. So you're gonna have that be insured properly. What about you are saying, well, I don't want my business to have the property in here. I'm going to set up an LLC title holding company to hold my property. And so I have the business owns the real estate. Perfect. And this is to transfer the property to a separate legal entity formed to hold the title. Typically, it's a limited liability company or limited liability partnership. And with a pass-through structure, any expenses related to the real estate will flow through to your personal tax return and offset the rental income that the restaurant is paying you. A LLC is more commonly used for transfer the real estate, so it is simply to set up and require to get that set up and require only one member. If you have just one member, it's called single member LLC, so you file that LLC under 1040. Okay, so you don't need to set to file another return. But if you and your spouse jointly own that property, then you need to file 1065 partnership return. All right. So final thought, folks. And for you owning a commercial property inside your business running, and our conclusion from the get-go, I said it is better to be separated. So our final thought for you is that if you're interested in this strategy, the business can transfer ownership of the real estate, and then the transferee can lease it back to the company. Did you hear me? So you transfer and then you lease it back. So the new owner would have rental income. It isn't always advisable to separate the ownership of business from its real estate, but it is very crucial. It is very crucial for you to understand the risk within. One thing I want to say that if you run a solo law firm and you have part of your, you rented a office somewhere, and maybe you even bought a little building for yourself and you're running your legal advisory legal firm in it, and how much of a business risk from the legal practice versus this property. So maybe you are a lawyer and you are very confident with what you're doing, then you file them together. It is not the end of the world. Remember I said that you use insurance agent to give you insurance policy properly and you achieve same goal. But of course, you may say that then why are we even bothered? Because business risk is different. If you're running a distribution center, you're running a second car sales space, and you're running a restaurant, you're running a factory, you of course should separate that from real estate. Just don't bring your business risk into your building, because otherwise your building is listed on your balance sheet together, just right there with your inventory and everything else. All right? And contact us to help determine the best way to minimize your transfer cost, capital gain tax, while maximizing your potential tax saving benefit, all of that cash positive flow kind of help, right? Your tax strategist, people like us, we are your cash flow genius. If you are short of cash, always felt like you have to borrow money to pay taxes, something is not running right in your organization. I always say that, our United States of America has one of the best tax systems compared to all the other countries, and I have worked on. Our firm has a lot of international tax side of experience, so we understand the tax system. Canada, especially, that's where I graduated. That's where I practiced before, and so we understand. And we also understand a lot of Asian countries. We understand the South America. So we knew the tax system in different parts of the world. And I will tell you, here in America, our systems are very reasonable. If you are the one borrowing money to pay taxes, and I bet you dollar on the table that you are not doing your taxes right. You need to find the right tax strategist to do your taxes. All right. So these are our partners, listed on our website as well. When you click the appointment button, and uh, quite a few of us have a free 3 minutes. I don't have it. All of my time is something you committed to come in, and you'll pay us online, and we will come to the video conference with you and resolve your question and resolve your issue or give you a roadmap. And I knew for all these years I worked on video conference, solving questions, we have never had someone say that, Ying, give me back my dollars because you didn't answer my question. That's not a possibility in my range of knowledge, and I have answer for you. And right now, our firm is focused on tax planning service. Tax planning is a study we do for you to let you know that how is your 2024 gonna pan out. If we knew you're gonna pay a lot of tax, we're gonna drill in, spending time making sure that you know what to do before December 31st, 2024. Then have your tax done, have your tax liability limited, reduced, lessened. Okay, and that process, we don't produce 59 pages report for you just to impress you on the paper. We have 8 by 11 sheets. We summarize all your life on one page. Of course, we do a lot more work behind that page, but that one page tax chart, we call that tax map. It is really what you need. You will see everything you need to see. You know everything what you need to do. So tax planning service is something we do bill by our time, but it is so worth it. As long as you are the person paid a lot of taxes in the past, always felt like overpaid taxes, and had never really thought of investing some money of yours and learning some new rules and saving taxes, this is the time. Right now, the best time to do it. All right, my last slides for the day. And this is our YouTube channel. And we have this circle logo. And please subscribe and give us like when you like our video. Our website, you already see, communitycpa.com. We open 6 days a week, folks. We don't open 6 days a week only during tax season. No, our firm runs 6 days a week, and you call us on Saturday, we always a real person will answer your call. And our branches, we have 5 branches. As long as the branches has more than 3 professional staff, and then we open on Saturday. Otherwise, they only open Monday to Friday. We have 2 teams, right? Monday to Friday, Tuesday to Saturday. So I hope you are impressed with our operation and come to Community CPA, become our client, and we will show you path forward. I will talk to you again. Happy Saturday. Have a great weekend. Bye-bye.